Welcome in, everybody. Thank you so much for joining us today for the overview of the CIMA certification. We are the Investments and Wealth Institute, and we are joined today with a special guest, Ms. Kathleen Fitzgerald, the Clinical Professor of Strategic Management with the Chicago Booth School of Business. Now, before we get started, we'd love to hear where you're joining us from with our chat feature. We are based here in Denver, Colorado. Wisconsin, San Diego. Wonderful. Yeah, we'll get started here in just one moment. Just let everyone join in. New York, North Carolina, Chicago. Wow, we might hit every state today. We really appreciate everyone spending your morning with us. We have a great presentation for you. We'll go ahead and get started. Now, my name is Tyler Cook. I'm one of the two enrollment counselors here at the Investments and Wealth Institute. We're also joined today by Ms. Kayla Mathews. Our job here is to help answer any questions and facilitate any application related concerns. We're happy to be here to schedule one-on-one meetings or really go over any of the Investments and Wealth Institute offerings. You can scan either of our QR codes to schedule a meeting now, but we'll also send a link out to schedule with a recording to today's webinar. Now, today we're going to learn a little bit about the CIMA, a little bit about the curriculum and the different education providers and pathways in which you can earn the CIMA designation. We'll then learn about certification and becoming credentialed. We'll then finalize today with our spotlight session with Miss Kathleen Fitzgerald, covering manager search and selection and going over a little bit about the Chicago Booth offering and their program. Now, Kayla, talk to us a little bit this morning about the Investments and Wealth Institute for those who are unfamiliar.
Yeah, absolutely. So the Institute is dedicated to serving the educational needs of advanced investment and wealth professionals around the world. We pride ourselves on being the premier place financial advisors, wealth managers, and investment consultants turn to for their higher and premier educational needs. We're a trade association, an education provider, a standards body for financial advisors. We host in-person conferences. Next month will be in Fort Lauderdale, and November will be in Scottsdale for Experience 2026. We put on monthly online webinars. We offer the CIMA, CPWA, and RMA certification programs through our educational providers, Yale School of Management and the University of Chicago Booth School of Business. We also provide premier education online courses through the Institute's Academy for individuals to meet their professional development and learning objectives. What some people might not realize is that as an association, we work with top leaders in the profession to develop the educational programs to bring Ivy League quality, real-world practical solutions to the forefront so that advisors can implement strategies and changes immediately in their practice. We're truly a community for advisors by advisors. Now we're going to move into a little member snapshot. So here you can kind of see a little breakdown of all of our members. As you can see, we have a wide range of advisor channels who make up the CIMA holders. And with the CIMA, there's 46% of clients that are high net worth. I'm going to pass it
Thank,
back to Tyler.
thank you so much, Kayla. So let's talk about the CIMA a little bit. As we might know, the CIMA program is focusing on investment and portfolio design and management. The program was specifically designed for financial advisors and investment consultants managing the investment management needs of affluent and institutional clients. Now, the CIMA program aims to enhance your client experience, your investment and portfolio expertise, and is designed for working professionals looking to advance in their careers. We pride ourselves on having a realistic workload, as we all know that earning a new designation is adding on some time. We're partners with you as you go through this. We offer tons of support throughout the program. Now, a couple highlights about the CIMA program. It is accredited through the ANSI-ANAB Board of Accreditation. Now, it's amazing to note that the CIMA is part of fewer than 5% of all financial credentialing programs that meet accreditation standards. With research with CEG Worldwide and CEG Insights, we found that CIMA holders show higher income potential. We show that their teams on average hold a higher AUM. We also find that about 20% CIMA holders are about 20% more likely to work with high net worth professionals in that $5 million net worth plus than non-certified advisors, which comes to no surprise then that the CIMA has such a high value rating among those who have taken the program and started implementing what they've learned into their practice. Now, what does the CIMA teach and what topics do we go over? Now, Kathleen will go through these in grave detail shortly, but we wanted to give you an idea of the layout. There are 5 main core domains that you'll go through and 20 subtopics. As you go through the program, you'll experience different modules. Each module will be broken down in the CIMA detailed content outline, also known as our core body of knowledge. We'll be sure to send this out to you at the conclusion of today's program to give you an idea of the different modules and what you can expect to take away. Now, Kayla, talk to us a little bit now about the education providers with the CIMA program.
Yeah, absolutely. Like stated earlier, we partner with Yale and Chicago both, and we also have our in-house offering, which is going to be our CIMA Direct class. Yale will be fully virtual on demand. It's self-paced. You have access to the platform for 1 year, so you can kind of go through it as quickly or take as long as you need to get through it. There are no enrollment dates as everything is on demand. We also have with Chicago Booth. Chicago Booth is going to be our 3-month program. The first 13 weeks, you'll be going through each modules. You'll have weekly webinars with Kathleen Fitzgerald, where she'll be able to go over that week's content. It's really a course that involves a lot of interaction and hand-holding if needed. It also provides the flexibility where if you cannot attend those weekly webinars, they'll also be recorded for you to view at a later date. We also offer within that class the option to attend an in-person 2-day comprehensive review of everything that you learned throughout that program. And then it also provides a 3-part series of exam prep to really get you ready for the exam itself. Our in-house offering is a bit of a hybrid. It's going to be 90% online with a 10% live online option. So the first 3 months you'll be studying on your own, and then it wraps up with the 3-day live online comprehensive review. The in-house offering is going to be a little bit discounted since it is in-house and it's not partnered with another school, but they all offer different opportunities for you if you're a different type of learner. So how do you become CIMA certified? You're going to register with the Institute, submit your application online. You'll complete the executive education requirements through Chicago Booth and Yale or CIMA Direct. It's recommended that you spend about 100 to 250 hours of preparation and study. Advisors report typically 5 to 10 hours per week. Afterwards, you'll sit and pass a 4-hour computer-based exam with 135 multiple choice questions. Now I'm going to pass it to who everyone really came here to hear speak, Kathleen Fitzgerald. She is the clinical professor of strategic management with Chicago Booth. Kathleen, thank you for joining us today.
Good morning, everyone. Thanks, Kayla and Tyler and Carrie. Everyone can see me? I'm going to share my slides. How many of you are for sure doing the CIMA, and how many of you are like trying to figure it out while I do this? Can you let us know? Do we have any CFAs out there too, or other certifications? CPWA, researching, CFP, nice. That'll help you. We will help you figure it out. And the team at IWI is great. They can also help with any questions that you might have. So what I'm going to do today is I'm going to talk through the curriculum. I teach in the Booth program, as they said. And then I'm going to just do like a little teaser class on manager search and selection. Then we'll talk about the Chicago Booth program, and then we're going to bring IWI comes back, and we'll close the program, and we can all answer any questions that you have about the process or about the programs. So here's the IWI curriculum. It is specifically designed for investment management analysts, clearly, it's in the title. And what I love about it, it's a very comprehensive curriculum. So the way that the curriculum works is we come in, we do the fundamentals. So the fundamentals are the core topics that you'll need to understand to do the later topics. So we do statistics and methods. So these are things like mean, median, mode, variance, standard deviation, covariance, correlation, like all of the statistics underlying things like portfolio theory, asset pricing, option pricing, forward pricing, value at risk, etc. We talk about probability. Probability is more about inference, like what could happen in the future. Statistics and methods is more about descriptive statistics, right? We talk about time value of money. So things like lump sums, annuities, perpetuities, again, all of the tools that go into things like valuation and pricing. This is investment management. You have to understand economics. So as part of the fundamentals, we'll talk about microeconomics. This is at like the firm level, and macroeconomics at the economy level. So things like inflation, interest rates, shocks to the system, different types of models, business cycles. So all of the things that you need to know about I would say, the business environment. Like, we don't control the environment, but we certainly should be able to plan for differences in the environment and what we would want to do. Say, for example, if we're in a recession or we're in a boom, interest rates are high, interest rates are low, inflation is high, inflation is low. What effect will that have on the portfolios, and are there any changes that we need to make? And then it's important to understand what has happened in the past, right? Like, you tell me, recessions, are they more common or less common since, like, in the last 100 years? What would you say? David says less. Anyone agree with David? We all got to participate. He put his answer out there. I agree as well. Yeah, less common and less intense in nature as well. And then we want to think about, why? Is it because of the Fed? Are they doing better at keeping inflation and things like that at more of a steady state, right? So once we understand the environment and we have all the tools that we need, we move into, well, what could we invest in anyway, right? Like, what's an investment and what type of investments can we make? And what are some of the things that we care about in these investments? So when you're deciding whether to, how much should be equity, how much would be fixed income, what are some of the metrics that you consider? Like, I'll say the first one, like, you might consider liquidity. What else might you consider? Besides liquidity, think about your own life. Volatility, yeah. So we look at risk, right? We might use standard deviation as a measure of risk or a measure of volatility. Variance. So we care about liquidity. We care about variance. We care about returns. Yep. Expected returns. We might care about time horizon, right? We might care about regulations, right? All of these types of things we need to consider and learn for all different types of investments. So on the equity side, and we think about the difference between common stock and preferred stock, how to price it, what is the risk reward trade-off in equity, the difference between like domestic, international, frontier markets, emerging markets, established markets. You know, what are the differences? What type of, like if I asked you, what are the emerging markets? You might say BRICS, right? Things like that. On the fixed income, again, for all of these, we're just trying to think about the different structures. Fixed income will also do things like duration and convexity, pricing, like how sensitive is the price of our fixed income to changes in interest rates, and why should we care? And what does this mean for a portfolio? We talk about alternative investments. What are some alternatives that you might invest in or have your clients invest in? Real estate, private equity, venture capital, art, commodities, private credit. Ooh, that's a good one. How's that going lately? Yep. All different types of alternatives. And again, what are the differences between like these alternative assets and these more traditional financial assets? What would you say is like one of the things that we talk about alternatives and why they're a good addition to a portfolio? Yeah, correlation, diversification, perfect. I don't know if they're less volatile, but maybe they make your portfolio less volatile because of the diversification. Then within alternatives, because they're so important, we talk about options, call and puts, long and short, futures, other derivatives, option-like assets like warrants or convertible debt or convertible stock. Real assets gets its own little section. And then we think about, well, we know that we could invest directly in these things, but what are some other ways to invest? If you don't invest directly, what could you do? What are some vehicles you might use? Mutual funds, hedge funds, ETFs. Yeah, index funds. They can be either ETFs or mutual funds. SMAs, UITs, right? There's lots of alternatives. And we want to know like what's the benefit of an investment vehicle and what are the trade-offs. So once we like have the fundamentals, understand what we can invest in, then we have to think about, well, how do we put these things together in a portfolio, right? So of course we're going to talk about modern portfolio theory and postmodern portfolio theory, the importance of diversification, right? Different types of asset pricing models, capital asset pricing model, multi-factor models, efficient market hypothesis. So strong, semi-strong, and weak, right? Like efficient market hypothesis says that once information's out there, it gets immediately incorporated into price. And we want to think about, well, how efficient are markets? The other side of that coin is behavioral finance, which says that markets may not be efficient, right? People may not be rational, and people matter. So we'll talk about, you know, the basic tenets of behavioral finance and the different type of biases and mitigation techniques. Someone said that they did the CFP. I think you did a lot of that in there. You might have done some of it in CPWA, if any of you have taken that. And then we think about, well, how do we put these? So we have the basic core theories, and then we think about, well, what are our different investment philosophies? So what could be something like value, growth. It could be strategic portfolios where we kind of like pick a weighting and we keep it there, 60-40, equity, debt, until some life change happens. Tactical, dynamic, right? Buy and hold, constant mix, and so on. So how do we actually put these things together? And then once we have our portfolios, several of you mentioned risk and return. Well, what we need to be able to measure the performance. So how much risk did we take on? What are some different types of risk? You said volatility, that can be variance or standard deviation. What are some other types of risk that we might care about? Market risk, so beta, systematic risk, really good. Value at risk, you know, what's the worst 5% that could happen? Yep, systematic risk, idiosyncratic risk, tracking error, credit risk, default risk, currency, inflation, right? What are all the things that we're exposed to? Yeah. And how do we measure them, right? So it's like the concept of the risk and the measurement of that risk. And then when it comes to performance measurement, how did we do? What's like the one thing what comes to mind when we think about performance measurement? Alpha. Yeah, everyone thinks about alpha. So alpha, Jensen's alpha. ROFI. What's ROFI? Return on fees invested. Okay. ROIC. Return on invested capital. Information ratios, Sharp, Trainer, M squared, many. We'll talk about the pros and the cons, what type of risk adjustments are being made, and so on. And then attribution is about, okay, let's say we beat or did worse than the benchmark. Was it because of asset allocation? So not being in the right asset class at the right time, or being in the right asset class at the right time, or asset selection. Like within asset classes, were we picking good investments? So we'll break everything down, right? Because it's important to know if you have alpha, but where did it come from, right? Did it come from because you took on too much risk or more risk than you were supposed to based on your benchmark? Did it come from luck or did it come from skill? And we break all of those things down. And then finally, the last section, probably the most important section, but it's actually, by the time we get there, the easiest section, because we've done all the hard work in sections 1 through 4, and now we're putting it together in your day-to-day role, right? So to be certified, there's a code of professional responsibility that you're expected to know, like any certification. You should also know the disciplinary rules. And then we think about, well, what's our consulting process, right? Like, who's our client? What type of clients can you have? Sure, you can have individuals, but who else? What are some of your clients? Endowments? What else? Foundations? Small businesses? High net worth? Yep. Like within individuals, there's differences. Family offices, pensions, insurance, life insurance or property. So when it comes to clients, we want to know, like, what's the terminal use of funds? What is their time horizon? Who has long time horizons? Who might have short time horizons? Who can take on more risk? Who can take on less risk? Who cares more about liquidity or less about liquidity? And then where do we put all this information? Into investment policy statements, right? IPS. So in the IPS, we want to know about the governance of what's going on, we want to know about the client, and we want to know about investments. So we should be really familiar with the different sections of an IPS, even if you don't use them. Some people don't use them. The things that go into them, if they're used, are relevant for everyone, right? And then how do we implement it? Again, this is more about how do we put these portfolios together? Like, how do we decide asset allocation, for example? And then once we decide how we want to allocate our assets and what we want to put in them, who should we put in? Who are the managers of these investments? And we're going to talk a little bit more about manager search and selection as an example, but you're entrusting your clients' money with these people. So how do you find them? How do you choose them? And how do you monitor them, right? And then finally, portfolio review and revisions. This is about feedback, monitoring, and things like rebalancing if necessary. So it's very comprehensive, this curriculum. And the way that IWI has it is, you're required to do an education program. So in the education program, for example, at Booth, you've got things that you learn that not necessarily are tested. Yale would be the same. I'm sure IWI's new program will be the same. So this is to make you this is to help you with your career. And then the other component of it is the certification, which is a subset of that. At Booth in our program, so the 12 to 16-week program, we'll do the education, and we will also do the certification exam prep at the same time. So our goal is so that when you leave, you are very well-rounded and you understand deeply a lot of things, but you're also quite prepared to take the exam. And that's our dual focus. So if we think about the exam, in the IWI candidate handbook, manager search and selection is 6% of the exam. And what they do is they lay out specifically what are the different things that you need to learn. And then they give you some context as well about why you need to learn it and what types of things you should be able to say, right? Like you should be able to apply research, identify clues, select the best manager, think about having a single manager or a multi-manager approach. So the IWI candidate handbook, you saw it up there earlier, they're very good. It's very detailed on what you need to know. And the examiners, the people writing the exam, use this to determine what's on the exam. Okay, so it's very clear. It shouldn't be random. It's not random. They're very conscientious about the whole thing. So let's talk about manager search and selection. Any questions before we go? Do you feel all right? Are we good? Tracking? Someone say yes or no. Don't leave me hanging. Tracking. Thank you, David. So how many of you hire managers? Do you all look for managers? I mean, you can't do everything, right? But it's an essential part of the financial advisory practice, as you know, right? And it requires constant due diligence. So what you need in your practice is a well-structured, efficient process that addresses regulatory requirements, helps you and your clients achieve your investment objectives, and frees up your time to do what you do best, which is to focus on your clients, right? So you kind of get the infrastructure in place so you can rely on it and focus on helping your clients. So the main steps are like, why are we looking for a manager? What's our selection criteria? Let's screen the universe and see, well, who's out there? Do our due diligence, make our decision, and monitor. Those are the 6 main steps. So why would we be looking for a manager? Maybe you're just doing an addition to your buy list. You need to fill in some gaps. We don't have any good ETFs, for example, that deals in commodities, or we would really like more some exposure to private equity or venture capital. Maybe you want to replace your current manager, or maybe you're just trying to build the bench of replacements, right? It's a time-consuming process doing manager search and selection. So if someone drops, it's good to have someone ready to go, right? So sometimes it's just a constant process of making sure that you have a replacement. Selection criteria. So asset class is an obvious one, right? We need more equity in, biomedical, or sector, their style, value or growth, the size, larger assets under management, for example. Performance and risk metrics, like what are their absolute returns? What are their relative returns? What are their returns in different market conditions, right? Like you're going to have some that you want that will pay off when times are bad. So if you can't really just like look back and say, oh, when times are good, they didn't do very well, because you actually need these people for when times are bad. You can look at all these measures that we learned throughout the program: Sharp, alpha, tracking error, information ratio, upside downside capture. Like these are all metrics that you'll learn, if you don't know them already, and understand how to apply in the manager search and selection process. It could be tenure. How long has this fund been around? Do they have an online platform? What are their fees? What are their assets under management? Other things as well, like skin in the game, succession strategies, lots of different things that you may consider, and we'll go through them. So you have your selection criteria, and then you need to go out and see who are the possible candidates. Who are these people or companies? You can do it electronically, you can do it manually, you can outsource it, right? There are firms out there that will do that for you. Just a quick search online, right? Like here's like one company that will simplify it, find funds, and help you analyze, right? As industries get broader, you find a lot of specialists, and at some point, maybe it's easier to outsource, right? So you screen your universe, and then you need to do your due diligence. So we're trying to break this list of possible candidates to a list of probable candidates. So we've got a funnel, and let's like bring it down. So what's involved in due diligence? Well, questionnaires, look at their documents, interviews, site visits. What do some of you do? What do you do, Brian, David, when you're doing due diligence? Depends, sometimes you can do site visits, sometimes you can't, but you got to get in front of them, right? Then you look at their quantitative, their track record, and their performance statistics. Dig deeper into details, right? We might have said, oh, we care about excess returns, but now we want to know more about, hey, where did these come from? And when did they happen? And what managers were getting them within the firm? And what is the process, right? How is the company run? And these are some background checks, cybersecurity, very important these days. What software do they use? Are they running everything off an Excel document? Are they more sophisticated? Who's on the team? Who's the key talent? How are they paid? What's their incentive structure? Again, their succession plan. What is their investment process? How do they do research? How do they make decisions? How do they put portfolios together? How compliant are they? How complex are they? If you don't understand it, if they can't explain it in a way that you understand it, that's a red flag, right? Because you need to be able to explain to your clients what's going on with this. So you want to be able to make sure you understand it. If you put it into a table, like IWI would focus on like these 4 Ps, sometimes you see 5 Ps. They're just ways to categorize information so it makes it easier for you to remember and understand and put together, right? Like it's the same thing we had before, but more structured. So we'll give you some different ways to learn these things and get them in your head. But for me, it's not about memorization. It's about, and this is what we really emphasize at Booth, don't memorize, understand. So that you're not always trying to like, oh, then let me get into that framework. Say, no, this is part of me, right? This is what we understand now. And then you don't need so many of these tools. So you have these probable candidates. Say you got it down to 5 candidates. Now you have to say, what's our selection rationale? What are we using as the final criteria to decide on the firm, on the team, on their strategy, on their investment philosophy and process, on how they put things together, drivers, etc. You decide this, like what's the most important to you. And then you need to also document before things happen, what would make you want to exit, right? So what are some triggers that would say we need to reevaluate this relationship? Style drift, manager change, assets under management, maybe we're getting too large, they can't execute on strategies, some deterioration in performance or compliance, anything. Like what is the trigger for you to leave the relationship? Any type of unexpected underperformance in these things, you do have to temper it a bit, right? There's recognizing mistakes early, and then there's like being a little bit patient to get in the groove, and you decide what those conditions are. And you would have charts like, what would we expect from this particular manager in different market conditions, right? That's just pulled that out as an illustration. And then you need to monitor systematic monitoring, periodic meetings, phone calls, keeping an eye in the industry. Is there anything going on with this company that we need to worry about? Just not like choose a manager and let it go, right? Choose the manager and monitor. Make sense? Does this like, this is a high level of what we would cover in the program, but I think it's a pretty comprehensive in the sense is that's the main process. And then we would dig into the details. We can try a couple practice problems. So now I want you to tell me your answers, all right? So here's a practice problem. A manager has outperformed its benchmark for 5 consecutive years. Can you hear any noise in the background? If you can, I'm sorry. There seems to be some type of, I feel like it's like, you know, those leaf blowers, something like that going. Assets under management have tripled. The investment team is unchanged, but the strategy is expanded into less liquid securities. So what would you say? A, manager's skill is clearly improving. This increase in asset under management may affect the strategy's ability to execute. The unchanged team eliminates concern about future performance, or expansion into less liquid securities reduces risk. What would be your answer? You have to enter. I got a B. Everyone's saying B. Ching, ching, totally agree. Some of these things may also be true, right? Expansion into less liquid securities does reduce risk, but who cares, right? You chose this manager for a certain risk return combination. And sometimes when assets under management get too big, they can't execute, right? Just because the assets aren't out there to execute with. So yeah, that would definitely be B. Very good. Active share. So 2 equity managers both outperform their benchmark. Manager A has an active share of 85%. Manager B has an active share of 35%. Which statement is most accurate? B is more likely to generate alpha. A is more likely to be benchmark hugging. A is more likely to be truly active, or active share guarantees outperformance. What would you say? It might be just too easy. Or not easy. The thing is, a lot of what these answers, A and B, are requiring some assumptions that we did not provide. D is just obviously not true, right? Just because you're more active doesn't mean that you're going to outperform, right? The true answer would be C, right? Just because, so active share doesn't mean that you'll have alpha. You could be active and doing poorly, but I didn't say positive or negative alpha. And so that could be an answer. But we have to find the best answer. And benchmark hugging, I didn't say what kind of fund it's supposed to be, how active it's supposed to be. But what we know for a fact is that manager A is more truly active. They have more active share, right? So a lot of exam testing, and we'll work on this in the program. We have lots of practice problems, and we're making a new database at Booth for practice problems. So we're going to spend some time on learning how to identify distractors and finding when there's two answers that look correct, how do we pick the best answer? Because I think that's mostly what happens. You've got two answers, but which one is right? Okay, another one. A manager historically classified as large cap value begins holding a significant number of mid-cap growth stocks. Is this best described as style consistency, style drift, factor timing, or benchmark misalignment? Andrew is correct. That is style drift. Yeah. And the rest of you. And then finally, one more, netting risk. So netting risk, this gets down to like multi-manager versus single manager. With multi-managers, you are exposed to netting risk. So for example, you could have two managers, one does well, and so let's say they earn 10%. So you're going to have to pay a performance fee on that. The other one does poorly, and you don't have to pay a performance fee, but they do more poorly than Fund A does well. So what ends up happening is you're paying performance fees on an overall losing portfolio. So that's netting risk, right? So here, Fund A returns 10%. How much would we actually get with a 20% performance fee? 8%. So what would be our net return? By the way, we have 50% in each fund. So what would be our net return? C is perfect. Yeah. Now 7 is in there as well, right? Because 7 captures the, minus plus 8 minus 15 is 7. But we have to remember it's like half of our money is at 8 and half is at minus 15. So what Andrew did, right? So the way that we will go through the material at Booth is we will explain it. We'll have like the formulas if necessary. We will do an example, and then we will do practice problems. So it's our program is very regimented. So I'm going to take a few minutes here and talk about the CIMA program at Booth. So I don't know much about the new program at IWI, but I do know a little bit more about Yale and Booth. I can tell you at Booth, it's a very disciplined approach. So Yale's a great program. They're all great programs. IWI is going to have a great program as well. It really comes down to what's your learning style. So let me tell you about what we do at Booth. So Booth is disciplined, I would say. We try to keep you on schedule. That's why we have the weekly review sessions where we cover the material. It's technically about a 3 to 4 month program, but we give you access to the materials about 5 months in advance. I mean, about 5 weeks in advance, and you also have access to the materials for at least a year. So you do have there is a lot of flexibility, but what we really focusing on is trying to keep you on schedule. So we have weekly modules. Every week you'll have some online videos to watch. And then every Wednesday night, we have a live online session where we go through the material. Here are the formulas. Here's some examples. Here's some practice. There'll be readings assigned every week, practice problems, and a quiz weekly. We will give you a midterm exam halfway through so you can check yourself. At the end of the program, we've got final quizzes and a booth final exam. Once you pass the booth exam, then you go ahead and take the certification exam. So we like you to finish that booth exam, and then the next month or so, we've got the 2-day workshop. This workshop, you can do it online, or you can come to Chicago live. It's great in Chicago. It's 2 days with 30 to 40 other people that are also working on this. So it's great for networking, meeting others, study groups, this type of thing. And then we have 3 dedicated practice problem sessions where you will come and we'll do 6 hours of practice problem, just hammering through them. Everything is recorded. We've got lots of faculty, 8 faculty, mostly tenured faculty, working in their expertise. So they do they'll do the online videos, and then I will come in and do the live videos with you every week. We're on CIMA 23. We've done this 23 times. So I think we got it down. I think that you will enjoy the program. It's a flexible hybrid format, some online, some live. Structured study schedule we provide. We give you continuous feedback on what's going on. We keep in with you. We've got like incentives for keeping you on track. It's really great, I think, being part of a cohort. We have a way for you to sign up for study groups. And you work with them throughout the program if that's what you like doing. In the classes every week, we will, you'll get to know everyone, get their characters. It's fun. I would say it's like one of the highlights of my week. And you are in trusted hands with experts. The modules, so pre-course preparation, will give you advice for the 5 weeks before. We do 4 weeks of foundations. Then we move into the advanced curriculum, and then the workshop and the practice problem solving. This is just a little chart of all the different things that we do to help reinforce your learning. And this would be like a typical week. So we say, kind of lightly read the chapters, watch the online videos for weeks 5 through 12, do practice problems, try to do some quick quiz problems, attend the online sections, and then for Thursday and Friday, just kind of wrap up that week and move on, right? Wrap it up, move it on. Our next program starts this summer, May 6th. I guess it's late fall, late spring. So this is our timeline. So you would come in pre-course preparation. You could do that sometime in April. And then we get going. Time goes by really quickly. And then by the end of summer, you'll be ready to take your exam. By fall, you'll take the certification exam and be CIMA certified. That's the goal. So the fee, as you know, this is $59.95, but I think, Rebecca, was that, or Carrie, isn't that higher now?
Yeah.
What is it?
Yes. So the fee is now $62.95.
Sorry for that. Come back at us and ask us for a $300 discount. Yeah. So it's $62.95. And when you talk to your advisors, Kayla and Tyler, you can also talk to Rebecca and Tessa from Booth. So we've got Rebecca. Rebecca, want to say hi, and Tessa.
Hi there.
They're the A team at Booth. They have answers to every question, 100% supportive, free, and all the way throughout and after the program. We're really lucky. And you know, of course, you've met Tyler and Kayla, extremely capable, very motivated. We'll answer any questions that you have on the differences in the programs and the benefits of the CIMA certification. I really do think this is a very good certification. It is not as time consuming as, say, for example, taking the CFA series. CFA series is not directly applicable to your roles. Well, the average role of a financial analyst, an advisor, but it covers like stuff from levels 1, 2, and 3 of CFA, but in a way that's all targeted towards you. A lot of work has gone into developing this certification and continual improvement. So I do 100% recommend the certification, no matter where you go. Although I hope that you'll come to Booth. I would love to meet you. And so would Rebecca and Tessa. We can give you testimonials for anyone that's been there in the past. So yeah. Here is, by the way, you can take a screenshot of it. You can take a picture of this if you want, but we will email you this presentation, either Kayla or Tyler, for everything that we went through. I think they actually post them somewhere. And here's just some upcoming dates. We've done a couple of these lately. You can look at the old ones too. I'm sure that Tyler and Kayla can let you know where they are. So now it's time for you to ask us questions. So please feel free to write your question in the chat. We're paying attention to it. And thank you for your time. Yeah, I'm gonna stop sharing. It's all yours, Tyler.
Wonderful. And thank you so much, Professor Fitzgerald. We really appreciate your time today and the entire Booth staff for being here. We wanted to just reach out a little bit more question and answer type session. We do have a Q&A feature in the chat bar. If you have any questions, send them over. We did want to address our scholarship. We do have a foundation that focuses on underfunded and underrepresented advisors and financial professionals. If you would like more information, please scan the QR code here or reach out to Kayla or myself. Now, we wanted to just give some basic Q&As as your questions pour in. Now, the prerequisites for the CIMA certification is 3 years of industry experience and a successful background check. Now, it's very important, and we already got our first question coming in, that you do not need 3 years of industry experience to begin the program. The 3 years of industry experience is required at the time of certification. If you have no industry experience, you can complete the program. You will just be in a limbo period until that 3 years of industry experience elapses. Now, in terms of what you need to do prior to starting the program, there is no pre-work. Once you apply for your respective program, you can expect 1 to 2 weeks or 7 to 10 business days for processing. And we do provide you with a candidate resource center for resources as you are looking to begin the program. Now, Kayla, talk to us a little bit about what's next in the Q&A.
Yeah, so when do you schedule your CIMA certification? After you complete the education, we will want you to schedule your exam within 90 days, typically after completing the education. That way the information is still fresh in your mind. You're able to go in person at a Pearson VUE testing center, or you can take it through ProctorU with your webcam for audit and compliant purposes. So it is very flexible. The exam is offered typically on rotation every couple of weeks. So you should at least have one opportunity per month for the most part. What happens if you fail the CIMA? More than likely, you will not pass or you will not fail. We are currently at a 76% pass rate for first-time test takers. But if you do, there is a 30-day waiting period and then a $295 retake fee. Your first initial attempt is included in the tuition. And then ongoing renewal requirements. We do our renewal requirements on a biannual basis. So every 2 years, you'll be required to complete 40 hours of CE, a compliance disclosure, and renewal fee. We also see a lot of CFP holders coming in to come and take our certifications. So completing the CIMA also provides 28 hours of CE towards your CFP. Now, if we have any other questions that you guys have that we didn't cover, please feel free to use the chat.
Yeah, we had one question come in from Thomas, and I think Chicago Booth and Tessa would love to answer this one. If we can't make this coming session for the SEMA, is there another session? Can we sign up? Tell us more.
Oh, I can't hear you, Tessa.
Yeah, we can't hear you, Tessa.
Oh, go ahead, Tessa. We still can't hear. So I'll tell you. Yes, we have another session in the fall. So the fall session usually starts in September and goes through December. So, and then we'll have another one that starts. So we run 3 times a year. There's really a lot of flexibility. Yeah.
And then there was another question in regard to someone not having work experience. We do need 3 years to be fully certified, but you can apply for the CIMA, join, complete the education, and pass the exam all before you do hit that 3-year mark of experience. But you would just have to wait to be fully certified and use the marks until you do report 3 years of experience to us, and then it's verified.
Perfect. Thanks so much, Kayla. And thanks everyone for coming. We'll just stay another minute or two here for any last questions. But we want to just wrap up and say thank you for everybody joining us. If you have any individual questions, you want to talk one-on-one, some pain points, just want to chat about some of the additional offerings here at the Institute, Kayla and I would be happy to discuss with you. Thank you so much again for joining us. We appreciate your time. Thank you again to the Chicago booth staff. Have a great rest of your week. Thank you.
Thank you, everybody.
I thank you.